Well, good afternoon, everybody, and welcome to TradeStation. My name is Michael Burke. I'm Vice President of Client Training here at TradeStation, and I want to welcome you to another edition of our options trading series. Today's event, Hedging Ideas with Options, is hosted by Ed Modla, Director of Business Development at the Options Industry Council. And we'll get to Ed in just a minute. The following presentation is for educational purposes only. All of the symbols and trading ideas discussed by the instructor are for demonstration purposes and are not recommendations. Active trading is not suitable for everybody. Options trading, doubly so. Please take a look at the disclosure information that we're putting into the chat, and you can find additional disclosure information on the TradeStation website. If you're looking to get up to speed on the TradeStation platform, TradeStation Securities is now hosting a daily trading channel, which is called Getting Started with TradeStation on the youcantrade.com website. Every day there's something new to learn. You can ask questions, watch archive videos on all things TradeStation. Check it out with the link on the screen. It's free to join. And once you're ready to take your trading to that next level with TradeStation, you can subscribe to our new online masterclass. Now you can get all the same great advanced training that we offer in our in-person masterclass from the comfort of your home or office. And you get access to all the same great resources and special events that made our in-person masterclass so special. Next week, I am hosting a 5-day masterclass in strategy trading. So if you sign up and join the free trial for 14 days, you can attend my 5-day strategy trading masterclass absolutely free all next week. So check it out at the link here on the slide. So as I said, our presenter today is Ed Modla, who is the Director of Business Development at Options Industry Council. He's an expert in all things options, and Ed is just an outstanding educator, and it's always great to have Ed with us at these events. So Ed, I'm going to turn it over to you.
Thank you very much, Michael, and thank you as always for having me. Welcome, everyone. Thanks for joining us. Hopefully you're able to navigate the markets and manage your way through it. We've seen this before. We'll see it again. We'll just have to do our best as we get through it. I started in the options business in the late 90s, 1997, on the trading floors in Chicago and in New York, and spent most of my time as a professional market maker. You know, we were trading at non-directional, trading off theoretical values, bids and offers, and just trying to capture edge and stay neutral. Now, it's a different side of the fence that I'm on now. I was in the futures brokerage business for a while, and now just over 5 years educating retail and individual investors on how to use options in a portfolio. Today's topic is hedging with options, to walk through some of the different techniques that you can use to protect a position or a portfolio, some very basic and some more complex. Even with the basic strategies, I'll offer some commentary along the way that hopefully you can find useful for those of you who might be a little more advanced with your options trading. Here's our disclaimer. Options are not suitable for everyone. They are a complex and unique tool. It certainly takes some understanding and learning before you should use them in a live account. If you want to know more about OIC and who I work for, we were founded in 1992 as an unbiased, free options educational resources. Back then, 28 years ago, the exchanges were concerned about the myths and misconceptions that existed about the options product. So OIC was formed. Our website's at optionseducation.org. You can find videos, webinars that we do every month, and contact our service desk at options@theocc.com. We are a nonprofit funded by the Clearing Corporation. All of those clearing fees and transaction fees that go through with each order are collected by the clearinghouse, and a portion of their budget is given to OIC to operate. So we are considered a nonprofit industry resource. I want to start with a look at options volume, considering what we're dealing with here in the first quarter of 2020. You can see, certainly it's interesting to check this graph out. At the turn of the century, you had really an explosion of options volume. Certainly electronic trading had a lot to do with that. Do-it-yourself investing, more awareness and education surrounding the options product really conveyed the message to investors that this is useful and you can do things with options you can't do with other products. They can be very helpful and useful in a portfolio. You see the explosive growth here. 2011 was the year of the European sovereign debt crisis. Had a little spike in volume there. It was really impressive after that year with very low volatility and not much movement in the markets other than drifting higher. Still 4 billion contracts, billions over here on the left, 4 billion contracts a year across until you set new records back in 2018. Just cracked over 5 billion, 2019 just under 5 billion. And for context, 5 billion contracts comes out to about 19.8 million contracts traded every single day. And that's the average that we were surrounded here with over the past 2 years. And that was a record-setting years and record-setting numbers. Well, certainly at the beginning of 2020, closing in on the finish of Q1, there's been extraordinary volume and extraordinary movement in the markets. Options have come to the forefront as investors are managing their way through it. So far, as we sit here today in mid-March, the average daily volume in the options space is just over 28 million contracts a day. That's a pace that would put us around 7 billion for the year. Now, certainly we don't expect that to last. You never know, but don't expect that to last. But the message here really is the use of the product. It's not a time to celebrate. We know why this is happening. People are stressed. People are losing money. We have a serious situation going on around the world. So it's no cause for applause, but it certainly conveys the message that when the markets are stressed, when investors are really looking for a product to help them get through this type of situation, to manage money and to find opportunities wherever there are opportunities, and to do so in a very risk-controlled way, the options product continually gets utilized more and more. We've seen corrections before. We're seeing one now, and we're setting records with volume numbers as volume keeps increasing. So let's take a look at our outline for today. I'm going to bounce around to some different strategies and walk through hedging techniques and why this covered calls are in here. A lot of people trade covered calls. I have a few comments on the slight mitigation of risk that covered calls provides, protective puts, of course, merge those into collars. And I'll get deeper into collars and variations of the collars, and then talk ratio spreads at the end. This is where it gets a little more complex, but certainly simple enough to understand. So a little bit of gradual move in complexity throughout the presentation, starting with more on the basic side and then moving a little bit forward as we get to the end. Starting with covered calls, just to take a step all the way back to the beginning, what is a covered call? For those of you who are new, covered calls have two pieces. One of them is long underlying shares of stock, and the other is short, or to be an option writer of a call option. For each 100 shares owned, the writer can sell one call contract. If they were long 500, they could sell 5 contracts if they wanted to. The reason to sell call options is simply to get the option premium. That's all you want. That is 100% the goal, to receive the option premium that lowers the overall cost, lowers the risk involved in the position. It provides a buffer zone, lowering the break-even point so you can absorb a little bit of a loss on the stock position and not suffer overall loss in your account. That is the goal, and that's very important. It increases your likelihood of success if you can lower a break-even point. In return, you have obligations. Anytime you sell an option, you are going to take on obligations in order to receive that premium. And here, anytime you sell a call option, you're obligated to sell the underlying shares at the strike price of the option if you are assigned. Now, of course, you can choose the strike price and you can choose the expiration date that you have this obligation. The shorter the expiration date and the higher the strike price, the less money you're going to receive for the option. The lower you go in strike price, the more likely it gets called away and you get paid more for that So there's a balance that you have to undergo when choosing your option strike price and expiration. Now, how aggressive do you want to be? How much premium is worth it to you? And then you select your strike from there. Now, once the position is on, assignment could occur at any time before expiration. We're talking equity and ETF options. The exercise style is called American style. It has nothing to do with geography. American style means the option can be exercised or assigned, in this case, on any day prior to expiration. Now, generally speaking, just the commentary here, it is unlikely for a call option to be exercised early in the absence of a dividend. Think about it from the call holder or buyer's perspective. If they own a call option and exercise it, they then have to pay for shares of stock. In the absence of a dividend, there's really no reason to do that before they have to. If they want to be long the shares and capitalize on the move higher, they could just own the call option and still capitalize on that move higher without having to buy the shares before expiration date. Dividends changes that a little bit. A call option holder does not have any entitlement to a dividend payment. Only shareholders do. So when you're selling call options, it's important to be aware of that. If your option goes in the money just prior to the ex-dividend date, then the call holder might want to exercise early so they can become a shareholder to get the dividend. That means on the other side, on the flip side, you might be assigned. One other thing to say about that, just because I think it doesn't get enough attention from various education in the option space. As I said, if the call holder exercises early, they're giving up their time value in the option in order to receive the dividend. So it's fair to say if the dividend is greater than the time value, then it's worth it for them to exercise early. And of course, we're talking in the money call options. However, another alternative for the call holder might be to sell the option, receive the time premium through the sale, and then go out into the stock market and buy shares. And in that case, they could actually receive both. They capture the intrinsic value and the time value by selling the call option, and they can go out and buy shares and capture the dividend and do all that prior to X date and get both. So that's a choice for the option holder, but from the other side, the writer side, be aware of those obligations, especially for dividend paying stocks. Now, for all the strategies today, the best way to look and analyze a strategy is to see the profit and loss chart and look at an example. So here we have the stock at 52, and the example is to sell the 55 strike call option for $1.75. That's why we're selling this option. That's why we're executing the covered call, to get 175 or $175, because each call option represents 100 shares priced on a per share basis. So now what happens? Well, look at what the break-even point now becomes. If we just bought shares of stock, it would be 52, and now we've lowered it. On the graph, the green dashed line is buying shares of stock. If we just bought shares, there's your break-even point. Selling the option lowers costs, lowers break-even, and gives you this buffer of roughly 3.5% to the downside before you start to lose money. And that's a very strong benefit towards doing this strategy. Now, what you give up is massive upside potential. If the stock really rallies through this 55 line, then you can't make any more money because you're obligated to sell shares here. Now, I want to explain one other thing focused on the upside. Now, one question that comes up is, well, if the stock rallies through the strike, should the investor hold that position and just let the shares get called away? You've maximized your gain, just go ahead and let it get called away. And the answer is you certainly could do that. But I do want to explain one thing. Once the option runs out of time value, you have nothing left to gain on the position. At that point, you only have risk to the downside. So if you put those two together, you have nothing left to gain. You have all risk. Well, that's probably a decent time to consider getting out of the position with all risk and no reward. And you can track that. Let's say the stock in this case went up to $60. Well, we sold a 55 call. It's now in the money. Buy $5. There's $5 of intrinsic value We can look on our options monitor and see, well, where is this trading? If it's a 490 bid offered at 510, it's trading for $5. It's valued at 5. There's no more time value or decay that we can get out of this trade. So there's nothing left that we can profit. And that's where you have the situation of all risk and no reward. Now, if the market was 520 bid at 540, well, now you know there's about 30 cents left of time value. And if you didn't do anything and you waited for this to get called away, you can extract another 30 cents of time value. It's very important to track that if your option goes in the money and you have time left. You certainly wouldn't want to maybe hold a position for a week or 2 weeks if you have all risk and no reward. Now, what about the downside? When the stock really sells off, for the under most market conditions, investors will say, well, I'm just going to sell another call option. If I really don't like the trade, I'll just get out. And by and large, investors are thinking, well, I'm selling a 1-month option. It's at 55. Maybe it goes down to 51, 50, 49, or in the high 40s, and then they have to manage their way out of it. And you certainly can do that. But what if it really gets hit? And we've seen some big moves in the market. You bought shares at 52, you sold the 55 call, and now you're trading all the way down at 40 or 38. Now what can you do? It gets really hard. The option's gone to zero. There's really nothing you can do unless you sell another call at a much, much lower strike price. So it's a tough position to be when you're there. There is one option strategy of forecasting what I'll be doing at the end with the ratio spread. Keep this in mind and come back to the setup that I just gave you of what do you do if you're really underwater on that stock position and you're trying to use the options market to give you a better chance to get out without taking on more risk. And that is something I'll get to, I said, the last strategy of the day with the ratio spread. So there's the covered call. To summarize all of that, the strategy works in a neutral to moderately bullish environment. If you have big moves in either direction, then it doesn't work out for you. Big moves higher, well, you would have been better off with a higher delta position, or maybe just long stock. And a big move lower, of course, you just have that mitigated small amount of protection to the downside. When you get huge moves to the downside and you haven't seen those in a while, then maybe now you have a little bit more respect for just how small that protection can be with the covered call as it's traditionally constructed with no downside protection. And that's where I want to go next, moving to the next strategy with the protection side. So here we are, protective puts. This is the classic form of buying insurance, and we buy insurance on our homes, our lives, our cars. Many people are not buying insurance on their money. And that's what protective puts are. They are the classic form of buying insurance on your portfolio. When you buy a put option, you pay up front and you own the right to sell shares of stock at the strike price, and you own that right for a certain length of time. So it's similar to buying an insurance policy. You choose the strike price, you choose the expiration date. The longer the expiration date, the more it's going to cost you. And the strike price, well, the higher the strike price, meaning the earlier you can get out of this trade, the more that's going to cost you. So you have to determine what is your risk tolerance, how much protection do you want, how concerned are you about current market conditions, and then decide what strike price and expiration date are you looking for. Now, certainly when times are calm and the market's moving higher, puts, they're still going to be expensive. Insurance in general is just expensive. But when the market corrects, then they really explode in value, and it becomes difficult to go in and buy that protection. Theoretically, it's like buying the insurance after the fire. And that can be very expensive and difficult to do. But this is how it works. And it may be information for a future time, or something you can implement in some capacity as I add more layers of complexity to these strategies moving forward. But also remember, you can determine how much coverage you want. This is the flexibility of the options space and using the options product. You want to protect the entire position, part of it. Maybe you want to go down a certain amount. You're willing to give up a certain level. That's like the deductible of an insurance policy. If you own shares at 45 and you purchase a put option that gives you the right to sell those shares at 40, Well, you're now giving up the first $5 of losses. That is similar to a deductible before your insurance policy starts to pay off. And now, just like before, I want to put up a profit and loss graph. And here we go, long stock at 60. And in this case, just going to buy the at the money, right at the 60 strike for $1. Maybe this expires in a month or so. And you can see that $1 is a sunk cost. You have to make that back. At expiration, the stock has to pay you back $1 before you can be profitable. And that's what you give up. That cost, that initial entry cost, is what you give up. And what you get in return is if the stock sells off to 55, 50, or anywhere below, it cannot get any worse than losing that $1, that $1 you paid for the put option. So this is similar in some ways to using a stop loss and guaranteeing you can get out of a position, but there's differences, and I really want to point out those differences. There's a time and a place to use a stop loss, and there certainly is. So what is the difference? Well, certainly what jumps out at you right away is a stop loss doesn't cost you anything. A stop loss is free. A protective put is going to be costly, and you can choose how costly it is. But the lower the cost goes, the less protection you get, and it's going to be expensive. You know, this option here may have just lasted a few weeks and then it's gone. And you have to buy another insurance policy after that. So you have to keep buying them, and they're not cheap. So that's the big disadvantage of using protective puts. They cost money, they're not cheap, and if you're going to always have this insurance policy in place, you have to keep buying them as they expire. Certainly is a big negative on the side for protective put. But what's on the other side? There's a number of things on the other side. First of all, the put option provides 24/7 protection. A stop loss does not. You don't get overnight protection. You don't get weekend protection. We've seen a number of occasions where Monday morning the market opens up significantly lower. If you have a stop loss in, but the opening print on Monday morning is far below that level, you're not protected where you thought you're going to be. So you have that kind of risk. Also, a flash crash. If you have a quick move lower followed by a rebound, you have a stop loss, you're out of that trade. Once it trades at that price, you move on and you're out of that trade, and you've exited the position. With an option, that's not the case. You can simply hold the option. You don't have to get out. You don't have to exercise early. You have the option and the protection in place until expiration date. So there's no need to rush out of the trade. You can hold it all the way through expiration, knowing it doesn't matter how low the stock goes and go all the way to zero. You're protected until expiration date. You can give yourself that length of time before exiting the position to see if the stock bounces and recovers. Also, if you change your mind after a retraction, in this case, if the stock started at 60, if it goes all the way down to 50 and it's starting to consolidate and you think it's going to turn around, and now all of a sudden you've turned bullish and you're not concerned anymore about the downside. Well, in that case, one choice of yours would be to sell the option. Let's say the stock's at 50. Now this 60 strike put might be trading for $10. So you bought one for $100. Now you can sell it for $1,000 and now get rid of your protection, lose the insurance, and be long shares of stock at a level that you're very bullish at. That's something else you can do with a put option, whereas a stop loss just gets you out and then would force you to possibly get back into the trade. So certainly some differences between stop losses and protective puts. I also get asked all the time, well, how many puts should I buy? And I'm not in a position to say how aggressive to be. From an educational perspective, certainly it's very simple to describe equity and ETF options. For every 100 shares you own, one option will protect the full position. If you have 1,000 shares, decide for yourself if you want to buy 5 or 3 or 7, whatever quantity is comfortable for you. You can buy different put options, buy different insurance policies. Buy 5 at this level, I'm going to buy 3 at this level, and buy a couple more at a different level. That's up to you. But what about a portfolio? And that's where I want to go next. As we look at an entire portfolio and you say, well, I've got a lot of stocks. I don't want to go in and buy options on all of them. I want to buy options on one particular underlying to protect the entire portfolio. So let's look at an example. The portfolio value is $100,000 and you're willing to give up that first 10%. That's the deductible, 10% loss, or from 100,000 down to 90. And then you want the rest of it to be protected. So that's your objective here. Now the hard part might be finding the underlying or ETF that closely resembles your portfolio. It's critical to have a symbol in mind whose performance is going to closely resemble the performance of your portfolio. You have to make that decision. Now, let's say you choose an ETF. You have a very diversified portfolio, and you go out and you find an ETF that's going to be a good resemble well your portfolio performance, and it's trading for $250 a share. Let's walk through that. Well, we said we're going to give up the first 10%. We're not concerned about protection for the first 10%. So first we discount the current level by 10%. We're doing this here. This is going to choose our strike price, take the 250 level today, go down 10% to 225, and now we've selected the strike price. Next question is, how long do we want the policy to last? Purely up to you. You can look at the prices that are available and decide you want 3 months, 6 months, or a year. Of course, you're going to pay more for 1 year, but the decay on 1 year is going to be very slow as compared to the shorter term. So the length of protection is up to you. In this case, we chose a 3-month 225 put, and we can see that it's trading for $3, which means we're going to pay $3 for each one that we buy. Now, we just want to buy options on this one singular ETF to protect the whole position. So how many do you have to buy? And think about that for a second, because it's very simple math. I'm going to put the formula up on the next slide, but it might not necessarily be intuitive. So as I get that ready, just think it through. Trying to protect 90,000, and we can buy this one put option for $3. So how many put options do we want to buy here? Well, here's how you do it. You take the entire amount of the portfolio that you want to protect, and you divide that by the notional value of the strike price. I'll say that in a different way, maybe in a little more simple terminology. If everything goes to zero, every stock, ETF, index, the whole market just goes to zero, then you're going to lose this $90,000. You want to protect it by being able to exercise a put option and receive $90,000 in cash and deliver whatever shares the ETF delivers, but they're worthless. Everything's at zero. So think about what it means to exercise just one option. You exercise the 225 strike, and you receive the strike times 100, or in this case, $22,500 you would receive for each one option that you purchased. If you want to protect 90,000, then you protect the full position by purchasing 4 puts. And that's how that calculation is. It's not too difficult to do. Like I said, the hard part might be just finding the ETF that resembles your portfolio. And then the rest is more or less choosing your strike price and expiration and then making this calculation. Here you can also see this is going to cost $1,200 to buy 4. You can buy fewer if you want, buy 2, buy 3, buy 1, and protect various amounts of your portfolio, completely up to you. And of course, this assumes a 1-to-1 correlation between your portfolio performance and the underlying you chose to hedge. Undoubtedly, there will be some variance between the performance of the two. And that is the tricky part, finding an underlying that's going to perform very closely to your portfolio. So there's covered calls and how it pertains to hedging and mitigating risk. There's protective puts. Now let's keep this going and get a little more complex with the collars. And this is fairly simple to understand, but there's different ways to do the collar, and I do want to get into all of that. The traditional collar is 3 pieces. It's straightforward. It's 2 strategies in one. It's merging the 2 strategies that I just went through. On the downside, it's a protective put, buying a put option to protect against long shares of stock. said earlier, buying puts can be quite expensive. Your motivation here is to protect the downside, but you don't want to pay all of that money for the protective puts. So you merge that with the idea of the covered call, selling a call option to offset the cost and limiting your upside potential profit. You accept the fact that you're limiting your upside in order to mitigate or recover the entire cost of the downside. P&L graph, pretty straightforward. Long stock at 75, selling a call option up here at 82.5. You can see P&L graph looks very much like a covered call up here. And on the downside, buying the 67.5 put, you can see the downside looks just like a protective put. Now let's think about these prices here. From 75, we went $7.50 to the downside, 7.5 to the upside. That's equidistant from the current stock level. But the put option cost more and we incurred a debit. A lot of investors want to do this collar as a zero cost or a no cost collar. In order to do that, you're likely going to have to skew your strikes a little bit and move this put strike lower or move the call strike lower. That skews it against you. You get a little less protection or your shares get called away a little bit earlier. And that's just because the volatility level in put options, which is driven by demand from market participants, is higher than call options. So prices of puts are higher than calls. When you're looking equidistant from the stock price, you usually see the puts trading higher. It's not a rule, it doesn't have to be that way, but usually that's what you see, and that's why you incur a debit in our example. Now, the what ifs in this case, if the stock rallies, maybe you're willing to get rid of shares. The traditional circumstance for using a collar often involves a stock position that is profitable. You've built it up over time. Maybe it's a concentrated position and now it takes up too much of a percentage of your portfolio. You're not comfortable with that. So getting rid of those shares is something you're completely fine with. You just want more out of it. So in this case, we're going up a ways, another $7.50. So you're trying to squeeze out more money. You're still bullish, but you're willing to start to unwind this position. Meanwhile, you don't want to give up all of those gains that you've built up over the years or of this large position. So that's where this collar comes into play. Now, there's different ways to do this. You'll find often when you use options in a live account, the traditional construction of strategies turns out to be your foundation of knowledge. But when you actually execute these strategies in a live account, you might be doing different things or variations, tweaking the construction of the position to your liking. And that's perfectly normal and very common to do. We talk collars, and I say the term collar or covered call because everyone knows what that means. We're all on the same page. But when you execute into your account, you might be doing things a little bit differently. So let's look at that. In the collar, a very common approach might be to stagger the expiration dates. We know that the time decay for shorter options is quicker. Theta accelerates 30, 35, 40 days out, right in that area. So maybe you're thinking, let's buy a put option that goes out a year, and let's sell a call option that expires in 2 weeks. And as the call option expires worthless, keep selling them over and over every 2 weeks. And it's a very logical approach. It's well thought out. There are things you have to be concerned about, which I'll get to in a second, but it makes sense. You have faster decay on the option you sold, slower decay on the option you bought. That's going to work out in your favor. If the stock consolidates or stays right around its current levels or drifts higher, then yeah, you can keep selling call options, keep receiving premium, and have that fast decay work out in your favor, and it could turn out perfectly for you. What you have to be concerned about are big moves in either direction. if the stock moved lower in a significant way, then the option you sold, the call option you sold, isn't paying off for you. You didn't get much for it. It goes to zero right away. You don't have much for it there. And now if you're going to keep selling calls, you'll have to drop your strike price significantly in order to keep selling calls 2 weeks or 4 weeks out. Otherwise, you're left going right back to selling a long-term call. So a big move lower doesn't work out as well when you stagger the expiration dates. Same thing with a big move higher. If you get an incredible move to the upside very quickly, the call option goes in the money, you didn't get much for it, you're in a position now where you're going to have your shares called away. The put option that you purchased going out a year for an expensive amount now is gravitating towards zero with the stock taking off. So that case as well, the staggered expirations would not work out as good as the traditional collar construction would. And that's staggering expirations. I want to walk through another one. And this is the put spread collar. It gets a little more complex here, but it's not too bad. I'll go through this nice and slow. We've got the investors long 100 shares from 105, and now the stock's up to 120. Again, classic circumstance for looking at the collar. Have a profitable position. It's built up over time and don't want to give it back. So the traditional collar here is going to say, well, let's sell the 125 calls and let's buy the 115 puts. That's going to be a very small debit. Now you've got protection on the downside at a strike price above your entry point. That's good, protecting profits. And if the stock continues to go up another 4+%, then you'll start to get rid of your shares and get out of the position. So there's your traditional collar. But now you might be looking at this 115 put and thinking that the put option protects your position all the way down to zero. And you might not necessarily need all of that protection. You might not want it. Now, certainly with tail risk, having the 115 put is comforting because you know you have protection against a major, major drop. But maybe there's a market circumstance you're saying, well, look, I'd like to have the protection if the stock drops down to here. But if we go down maybe a total of around 20% or 15%, I don't think I need all of that protection to the downside. And that's where the put spread collar can come in. You change your cost structure. Now you're selling two options. You're giving away the protection or the insurance on the downside by selling this put, and you're getting $1.60 for it. That's why you're selling the put, to get $1.60, change your cost structure, and turn the whole thing into a credit. But what you give up is downside protection. I'll just focus on upside and downside. To the upside here, you can see you're going to have a nice gain. Your shares will get called away at 125, and you'll have made $20 on the, you made $15 on the stock up, from 105 to 120, another $5 up to 125, and then you actually keep your credit overall on the option side. There's your gain. At 125 and above, you're limited. You can't make any more. On the downside, once you get to 115, you have protection for a full $10 or roughly a 10% move in the stock all the way down to 105, but now you sold it. You're not concerned about a move that far below the current level. So you sell the 105 to get some premium, change your cost structure. But now if the stock does drop down, you continue to mount losses. And if you go lower than here, 85, 80, then you continue to mount, as we'll see on the P&L graph here. If you continue to move lower, those losses mount greater and greater. So this is a little bit of a complex looking P&L graph. Again, the dashed line is being long shares. That's where you got them. Shares moved up to 120, and now you're going to protect against a short move lower. You're protected all the way through here, but this massive move lower is not something you're concerned about. So you change the whole option piece into a credit rather than pay anything, and you have the put spread collar. And of course, you can calculate all of this, the max profit, the difference between your long stock and the short call strike price plus the premium of $1 that you received here, and then your max loss is really what turns out to be your new break-even point. You remember we bought 105, we have $10 worth of protection, and we received $1. So 105 minus that 10 protection, minus that dollar of credit. So all the way down at 94 is our break-even point. From there on, we could stand to lose all the way down to zero. So different ways you can put the collar together, and certainly you can tweak strikes and volume. If you have a larger position, it gets really fun. You know, if you've got 1,000 shares, decide how many of these put spreads might you want to buy. You know, how many calls would you want to sell, and you can do different things to construct the trade in different ways. Let's finish it up with the ratio spreads. I don't think this strategy gets quite enough visibility in the option space, but certainly is worth knowing and keeping in your toolbox as you trade. I said earlier in the presentation, if you got a covered call position on and the market really crashes on you, you're left in a losing position. Same thing if you're doing cash secured puts and the market really heads lower. You might be in a tough position with a big losing position on stock. Shares are far under your break-even point. There's not much you can do there. You're trying to figure out, well, what do I do? In our example here, investor buys stock at 65, and it declines a decent amount down to 57. Now, the key here is the investor is still bullish. Now, if they weren't bullish, it's time to get out of this trade. But still bullish, looking to recover and recoup those losses. I like that it's 65, and I think it's still going to go. But now we're in a tough spot. It's got to get all the way up there. So what can you do? Well, you can just do nothing, stay the course, hope it rallies. Remember, it's got to go all the way back up to 65 for you to get to break even. You can scale in with more shares, buy another 100 shares at 57. That's going to cost you $5,700. That's reducing your cost basis, or scaling in. It reduces the break-even point down to 61. Now you have 200 shares of stock. That's doubling your risk. And you have an additional $5,700 that you have to pay into a position that is losing. Now, if the stock rallies back up to 65, you're profitable. Goes up to 70, you're really profitable if you double up. So this is an aggressive move. Where you can implement this stock repair idea using options with little or no additional funds. In my example on the next slide, we'll have no cost stock repair, no additional downside risk, and achieving this 61 break-even point. Now, of course, you have to give up something. Anytime you get a significant benefit, you have to give up something. This looks great. No additional cost, no additional downside risk, lower the break-even to 61. Now, those look too good to be true, but of course you give up something to get that. So let's take a look. And here it is. We said stock's at 57 right now. So we're down on this position. We're down here on the graph. The options piece is to buy one 57 strike call. You're buying one call option at its current level, and then selling two call options exactly in between, or as close as you can get. So from 65 down to 57, that's an $8 move lower. Right in between there is $4. So we buy one with a 57 call, we sell two of the 61 calls, and now we've got stock repair. What happens? If the stock continues to move lower, well, we've still got 100 shares. We didn't buy any more shares. We did this whole option piece at even money. So we didn't pay anything extra. We didn't get a credit either. So this is where that same exact risk concept comes in. Same risk to the downside. If the stock rallies, we've got 100 shares and we've also got the 57 calls. So you can see the steepness of this line doubles, and we will now be at break even at 61. But here's where we then give up something to the market. Short 261 calls means we're obligated to deliver the 100 shares we own. We neutralize the long call option as well. So above 61, we can't make any money. The way this has been constructed, we cannot profit on the trade. But for no additional cost and no additional risk, we lowered our break-even point in half. And that's the benefit of doing stock repair. Now, when it comes to doing this at even money, I can tell you have a much better chance of getting the option premiums to work out that way if you go longer in the expiration date. The later in expiration you go, option premiums sort of fan out from the middle out, and you have a better chance to get a stock or pair at even money. However, it may stick you in that position for a longer period of time. And with this risk that you have to wait longer to get this to pay off for you, as those options will not be as sensitive to the stock price itself. That can add some time to your risk. So there's stock repair, ratio spreads, protective puts, collars, a lot of different ways you can use options. And of course, you take these examples, you understand them, you tweak them to your liking, and change them however you want. And if you want more of all of that, we've got all of these strategies on our website, optionseducation.org. There's the service desk. You can contact them by email. We have webinars every month. You can find those on our website as well, and then all of our social media outlets. And that's what I had for you today. Michael, I will kick it back to you.
Hey, Ed, you had a couple questions in the chat if you want to take them.
Okay, let me see.
So the button for chat is right next to the screen share button.
Chat.
Where it might be in more.
It might be hidden in more.
Yeah. Okay, I think I found it. Here we go. Let's see. So let me scan this. Of course, I can't answer questions about a particular symbol or a particular trade. One question came in. Is there a particular delta that would be optimal for the covered call? The answer to these types of questions really continuously is no. And the reason why I say no is because every situation really is different. It's perfectly fine to have rules in place of what delta you like to sell. And I've heard many investors say, well, I like to sell 30 delta, 20 delta, 40 delta calls. Perfectly fine. But as an educator, what I would say is every situation's a little bit different. If you are more bullish on a particular position, maybe the 20 delta call looks good. But if you just think maybe the stock's at a support level, it's not going lower, I'd like to own it here, but I'm not sure. Maybe it just consolidates and doesn't really take off from this level. Well, maybe then you're looking at maybe 35 or 45 deltas. Get more premium for your call option. Really depends on how bullish you want to be. Now, certainly you can't go too far up because at some point the premium on those low delta options isn't worth selling. And you're taking on obligations, it has to be worth your while in order to sell the option. So I think each trade will be a little bit different, but a starting point for most investors might be around that 30 delta area. Another question, do you have to be a full-time trader to implement the techniques in your presentation? Absolutely not a necessity to be a full-time trader. When you use options, investors are attentive to their positions. It is a time-consuming effort. You're not usually setting and forgetting things. You're monitoring, you're watching. But these techniques and strategies that I went through today are really for your average investor who's managing their portfolio as wisely as they can, and they just want to do some different things to get protection, to receive some premium, to take advantage of the unique characteristics of the options product. By no means do you have to be full-time. It does take time to learn the strategies. You fully have to understand what rights and obligations are, exercise an assignment process, how to change positions, close them out, maybe do some position management. So understanding the product is what's important. Being full-time trader certainly is not necessary. And another question came in about giving an example for underlying versus portfolio. I don't have symbols that I can reference here specifically, but with respect to the underlying versus portfolio, buying a protection puts, just to reiterate, the key difference there really is all about finding the underlying that resembles your portfolio performance. And once you can do that, then you can then proceed to do the calculation, the simple math that I put up earlier, the amount of portfolio value you want to protect, the aggregate or a notional value of the strike price. Take a look at that and do the calculation to find out how many puts would be purchased for full protection. And then you can analyze that cost and maybe purchase fewer puts if you wanted to protect just less than that. Last question I'll take here. What strategy would you propose for increased profitability of the stock that I don't want to sell? And I like this question because when you talk about generating income and increasing profitability on stocks you own, selling calls is the way people go. And if you want to increase returns, you're certainly not going to be buying an option. You're not going to be selling a put unless you want to buy more shares. So selling call options is the way to go. But this question says, I don't want to sell the shares. And that's where the key is. No matter how much you don't want to sell shares, if you do short a call option, you're obligated to sell shares. If there's a buyout rumor and the stock really takes off through the strike, you might be stuck. You have to acknowledge the possibility that you might have to sell shares. Having said that, you can manage your way through this position. If the stock does start to rally up to your strike price, then you can go ahead and buy the call option back. Prior to the close on any trading day, if you buy the option back to close, your obligations are gone. You can't get assigned during the trading day. It's totally up to you. So when your strike price starts to be threatened, you're saying, I don't want to get rid of these shares. You can buy the option back, maybe at a loss, maybe for a scratch, or maybe even for a profit if it had already decayed. But buying it back is the only thing you can really do in that case. I do talk to investors who don't want to sell their shares, who still implement the covered call strategy. They just know, hey, there's a small chance here that I might get burned and I might have to sell these shares. Now, you certainly have to pay a lot more attention if the stock itself pays a dividend because the likelihood of assignment increases if the option goes in the money and a dividend is about to be paid. But really, there's really not other directions you can take increasing profitability on shares you own if you don't want to sell them off. And I think that'll cover the questions that I see here. So back to you guys.
Thanks very much, Ed. That was fantastic as always. Thanks everybody for joining us. We'll have an archive of this event up on YouTube in a couple of days, and take a look at the TradeStation calendar. We've got a bunch of events coming up the rest of this month. Hopefully you can join us. Thanks again, Ed. Thanks everybody for joining us, and have a great evening.